2:34 p.m. on August 28th, and I'm Tim Quast with Market Structure Edge, and along with me, as usual, as often as I can talk him into it, is market strategist Brian Wilson, and he and I are going to tag team today. So I will go first. Before we started recording, I was talking about the model portfolio. So I have been using our Focus Momentum model portfolio, and I was talking about how that has done. I mean, in the first part of the year, from a model standpoint, I wasn't using it yet then. We're just running the data. And then when we got to the point where we felt like, okay, we have done enough data science that we can use it. And we don't overanalyze things. If we feel we can produce the results consistently, then we're gonna try it. So I feel good about that. We got two more of them too, and I will come to that in just a moment. So I was talking about how that has performed since I've used it, and I don't know if Brad's here. He was asking me how many trades. Now, I mean, I do whatever it says. If it says exit this thing and buy that thing, I do it. I'm doing a bunch of other things. Sometimes I end up doing it after hours. I'm like, well, really easy to you don't get the best fills, as the traders would say. You might be price might not be the best, but I'm not caring about that in this particular exercise, because I just want to test the portfolio. There are going to be variances in our outcomes versus the model, because the model makes the assumption that it gets the closing price, and we may get a better or worse price than that. But I noticed, I noted that, for instance, Eli Lilly, I think my entry price was like $6.95. So I just did it whenever the model said to do it. And I sold it up $50 a share. I know that. When it told me to exit it, I was like, I hadn't even been paying attention. And I looked at it and saw that was a good, that's one thing. One thing is not a pattern or an example. And certainly I've sold other things at modest losses. I think generally I have not been disappointed with how that portfolio performs. It's only 5 stocks. So, the good news about that is it's very easy to manage. The bad news is one thing could derail your returns, and we're aware of that. So one of the other portfolios has 10 positions, and I'll show you those things. In fact, I guess I might as well here. Let me do this. I'll share my screen. So, we're running the Focus Momentum portfolio, which is, it's going to look for momentum stocks. Well, what happens if momentum ceases to be a good thing to pursue? Well, you want to change your portfolio. And it's done, this was not great, right? And it's had multiple periods where it has not done well. It has tended to be a precursor to poor performance. Here would be maybe the exception. Here, it was an indicator. Here, we certainly have flatter performance. It's certainly not down. We'll talk about that too. Is the market doing anything other than the data indicate? No, it's doing exactly what the data indicate. It's a very stable market with excess demand, which perfectly fits everything else we can observe. As long as there are relentless inflows from ETFs. I mentioned this last time. You can look at the monthly data from Morningstar, and look at the big fund families who are attracting inflows that have to be deployed, and funds that are losing assets. American funds lost in July $8 billion. T. Rowe Price lost $5 billion. You can look at this MFS, about the same, $20 billion out of the bottom 5. So. And the top 5 got close to $65 billion of assets to deploy. So what will that do? What will give the market a propensity toward an upward bias? And what stops that? I'll come around to that last. Anyway, this is what we have currently. It's certainly way outperformed the SPY. In the last little stretch here, less so. I mean, the gap has narrowed, and we're always looking at that standard deviation and relative performance. Currently, if you look at the portfolio, let's see, hang on. I didn't open this, so bear with me just 1 second here to get to the right spot, wherever that is. Might have to. Bear with me. I was just looking at it. So the moment I navigate away, there's nothing. Let me just open this. I just want to look at the portfolio today. I haven't made any changes today. We came down from we left Steamboat Springs at about 5:30 this morning. I like to get down here early, get ahead of the traffic. If you open these things and if you're one of we have a bunch of subscribers using this now. Thank you for that. It may resize on you at times. Okay, so here's where we are today. And this again is what I have been following. I'm vexing at times when you just bought, whatever United Health Group or NextEra, and then the next day it tells you to sell it. And these two are if you happen to take the closing price would be down 1%, but they may not be. Right? It's all about the timing, and that's why when we looked at it statistically, if there was variance in your timing, we tracked midpoint. Midpoint would be maybe a good proxy for the variance that you might get in a market that has at least 2% volatility all the time, highest to lowest prices. That it worked out statistically about the same. And look, it's a quantitative model. So you might say, well, I just bought that. Why is it telling me to sell it? Well, it just follows the criteria. And whenever the criteria change, it's going to look for, it has to have at least 2 in the portfolio. It could replace all of them. You'll see often 2 because that's what the model will look for. And here's where we want to be today. We would own Novartis. It's a real estate company, right? PLD, TXN, and CVS. And I'm just following it. And what I like about this is I don't have to think about it. I don't have to do much planning. I certainly don't sit and watch screens. I'm doing all of these transactions on my phone. So I might fit it in where I have a chance. So I'll just go, okay, I'll take that. And I might use market on close orders if I don't have time and they're going to be relatively small orders. If I'm taking a model portfolio, this thing runs $100,000. You could allocate it however you want. That it makes it very easy for me to rely on the data and the math to give me the decisions to make, and I just follow. And then we'll find out. In the model has been very effective. I just wanted to say I've been generally happy. I mean, generally happy that it has done what we hoped it would do, which would be give us good, reliable, high quality choices that we can get into and out of, that in the data indicate they will perform well, and that make it possible to not sit and watch screens and to have a relatively time-efficient approach to doing these things. Okay, now let me show you the other 2 that Brian and I have been talking about this.
Hey, Tim.
Yes, please.
I'm sorry, before just on that last thought, is the exit also market on close, or is the exit some other time?
If I'm busy, yes. If I think,
okay,
well, I can't, and why that? Because I know I'm going to get the best. The reason that matters, that's the reference price. So if you put the whole picture together and you've got, passive money, exchange traded funds, index funds dominating the market, that's the price they want. Now, the risk is the market deteriorates and I get a poor price. But generally, we know prices have a propensity to migrate toward the mean. And so maybe if the market's up during the day, maybe I don't get quite as good a price, but also the market has a propensity to if it's been weak, to move back toward the middle. And so it's an easy way to do both. Yes.
Yeah.
Now,
okay. Thanks.
Yeah. And as I mentioned before, you have to be careful about that, because if it ends up being all of your trading, you could end up with a modest extra charge because the exchanges they charge both sides of the trade there. The only time of the day that they do that, because it's where all the volume is. So the rest of the time they might pay you to sell. That's what it's called, the maker-taker market. What the maker-taker market says, if you are the best bid or offer, then you will be charged to take liquidity under most circumstances. Meaning I pay an exchange fee, but if I'm selling and I'm the best price, they will give me a trading credit called a rebate. It's what high frequency traders try to do, right? If you can balance it out so that you're net zero on trading costs and you capture 1/10 of a penny, you're making money for free. And the exchanges incentivize that because they want the best bid and offer. And that's why they do it. And there are what are called inverted markets, where they will pay you to sell or pay you to buy and charge you to sell. Like the BX, the NASDAQ BX market is an inverted market. Anyway, don't need to go down that rabbit hole. That's what I'm doing. I've done different things and it hasn't made any difference in my performance. Might as well go with what's easy. So, yeah. That does not apply to daily trading ideas. With daily trading ideas, I'm trying to get 2%. So I'm paying much more attention to volatility and the entry range and the exit range, right? Because that's a different undertaking where I want the highest probability of getting a predictable amount. Here, this is a longer horizon, purpose and time horizon, and I'm less concerned about it. Okay, so which is, I rag on the folks who are running managed accounts for me for their poor execution at times, and I have to grudgingly admit that I get some of it because they may have to do the same thing I do and just go, well, we'll do it when we can get to it, Anyway, so here are the other two that we have been looking at. So this is the take 2%. This portfolio does that. It's this also 5. The interest rate only applies. The model has built into it. What if there's a period where you don't find any stocks and you're sitting in cash? What if the model comes back and tells you we can't find anything? It happens. We're running these models all the time, and routinely there have been periods historically where the model comes back and says we can't put you in anything. So then you park in cash in the model, and that's what that is. This actually is that's kind of incongruent. So that we should probably, it has no bearing on the outcomes in the model, but should be 5. Minimum bound, you could turn out over the whole thing, but you should have 5 in your portfolio. Then it's greater than or equal to 8 with an uptrend in sentiment or flat or up. Volatility of at least 3%, so we're getting momentum stocks. I realize people ask me about this all the time. We could put this it's there at Edge. It's just not displayed. It's like we want $100 million of dollar flow. There are all kinds of ways to get to that. It's just a liquid stock. Short volume 5-day trend down. Short volume. This just matches. It's designed to match whatever the SPX is, and it happens to be 51% right now. Price close at least, so we want at least $20 stocks. And then to leave, either there's a 2% gain or the sentiment trend goes south. Either of those will be reasons to turn over the portfolio. Currently, the model portfolio, if you were doing, and how would you switch? Well, we switched. Let's say you switch from the momentum to the take 2. We just get rid of your momentum portfolio and make it your aim that at the next opportunity, this is the portfolio that you have. Today, if you were running it, it would get rid of GuideWire. I would have gotten rid of GuideWire a long time ago, but it's the model portfolio. And you would buy Futu, and this is what you would hold at the end of the day. So, and it's done pretty. It's not as good as the focus momentum portfolio, but it's not bad, right? Performance is, I'll go over the chart, not bad. It's struggled here of late too. It's interesting. If you from here to here, from July 3rd to present, it's underperformed SPY, which is clearly why we didn't use that portfolio. Right? Well, it's no good giving you something that is worse than SPY. And then finally, I want to show you and I'll stop here. This is the low volatility model portfolio. And this one, let's go over to the criteria. Yeah, this has 10 components. Why? Well, there's less volatility. And so to get return, you need a slightly larger group. And so it's going to very much, it's going to be less than 3% volatile. It's going to be stocks that are spending a lot of time at 5. Market cap range greater than 20 billion. That's another way to do it. Right? That's very easy to do with right now. If you want to go build a dynamic portfolio, you can make that choice. Supply demand divergence of greater than 2. So that's going to mean you're going to see some downs. If you've got a 5, then the downslope is only going to be on the supply side. To exit, sentiment that declines, or supply demand divergence that converges, stops diverging and converges. And so that has given us not great. I mean, it's better. All of these beat the S&P 500. It's outperformed the momentum portfolios, interestingly, here over that same rough period of time. Not great in here, but I think that was all Guidewire. I believe, was that the right portfolio? No, that was a different portfolio. Let's go look at this. So up 14%, and this is what it's got currently. Notice it's not a full 10 because it didn't replace everything. It's going to replace what it replaces. It's aiming for 10. It may not always be 10. It may put you in SPY. It's going to put you right into the market. So again, it's just a model. The model just runs data. That's all it does. Anyway, I think we will put those two in there as well to give you additional opportunities. If the reason I want to do this and have this discussion is, what if while I'm gone, the market implodes? Well, it's good to have, maybe these other portfolios would do better. Maybe you just sit in cash. I'm not saying it's gonna. There's nothing that would indicate to me that it's going to, but at some point it will. And that we can talk about in the next. Okay, Brian, I'm going to stop there. It took a little longer than I intended, but over to you.
I'm muted. Thank you, Tim. Appreciate that. A couple of topics to cover for myself today, and then Tim's got a bolt about 5 after the hour, so we'll try to wrap things up by that point in time. Wanted to show you, and I mentioned this in the note today, a couple of recent trends on the passive investment side, and Tim's done a great job of covering this topic. This is a modern IR report. We have some really good reports on the investor relations side of things, and I try to bring some of these numbers into play for you guys from time to time. But I wanted to show you what's happening on the passive investment side. So big picture over time. Once again, this is underlying stocks, S&P 500. You can see the trends. The trends are higher over time. 27.7 versus 200-day levels of 25.2. So just a lot of passive money.
And I might just interject really quickly if I can, Brian. Sorry about that.
Yep.
That means that's the percentage of volume. So if you took the S&P 500 and you said, well, if it trades whatever, $40 billion a day, what percentage of that is stock picking versus indexes and ETFs versus machines versus trades tied to derivatives, where the derivative, like a put or call, is the objective. And Brian's explaining the trends of that composition over time. Sorry, Brian.
No, that's a great explanation. So for instance, let's just take an easy example. 100,000 shares traded on the day. 9,600 of that would come from active money, 27,000 from passive money, and so forth. But the trend is higher over time. What else are we seeing over time for the S&P 500? Well, a reduction in volatility. So I think what is happening, what is passive money pursuing? They're pursuing average pricing. When you're pursuing average pricing, you're going to whittle away at the bid and ask, and intraday volatility is going to just decline over time. Take a peek at the SPY. So similar report, just looking at the SPY itself. The trends are even more pronounced here, moving from 20% all the way north of 24%. And take a peek at the intraday volatility trends. moving from 1.2, 70 basis points during the last 50 days. So I think there's a correlation between the two, as passive money is having a greater impact across the market. That then is reducing overall volatility. It won't last forever. We'll keep you apprised in terms of, if these numbers start to decline, we'll let you know in terms of overall leadership in the market. I did want to speak into, and I'll call it the topic, I'll call it alignment in the broad market. And what I'm getting at by alignment is, when do you know when to go long? When do you know when to go short? How do you know when to place those types of trades? And this is just my personal preference. When I'm going long, I like to go into SPXL. That gives me 3 times the leverage on the upside, or the converse side of that trade is SPXU, just the opposite side of that. So by being in alignment, this would be a good example. So let's say that the broad market had bottomed. In this case, we bottomed at 4.3. The broad market is moving higher. And let's say at the same time that sentiment was moving higher, you look at a couple of the other portfolios that perhaps you have, and you see that your all equity sentiment is moving higher. And you see that Dow Jones is moving higher, and perhaps mega cap is moving higher, big tech moving higher. So what I'm looking for is alignment between some of those different portfolios. What I'm tracking right now, it's a difficult period to make any predictions about that type of alignment. Why is that? Well, if you look at big tech's actually moving lower. So about 35% of the market is actually moving lower at this particular time. But the opposite side of that is broad market sentiment, which is north of 6. So to me, there's not alignment between the two. And that's part of the reason why I've not been placing directional trades recently. I've been using our model portfolio. I've been placing trades almost every day in our daily trading ideas, but I'm looking for alignment between, these various portfolios to give me an idea whether to go long or whether to go short. One other factor that you can bring into play is perhaps create a couple of portfolios having to do with short names. And over time, just get to know those portfolios, how many companies are normally in those. And at any given time, both of these portfolios, the average is actually exactly the same. They're both 19. But if one of them has 35 names on a particular day and the whole market is pointing me south, well, I'm getting alignment both from a portfolio perspective and from a short portfolio perspective. So just a couple thoughts there. I did want to share, I mentioned the daily trading ideas. I'll share one thought as it pertains to them. I'm always looking to trade between the low and the high on a given day. I will drop them into a watch list. And this has been working pretty well for me. Is anything 100%? No, of course not. You know that. But what I will do towards the end of the day, I'll look at these names and let's take BRBR. These are all going to be out of that high part of the zone. And I'll take a look at BRBR. It's not yet. And what I'm looking for is how is it doing relative to midpoint pricing? That's been working pretty well for me. So towards the end of the day, if this starts to move higher, in other words, it's moving above the midpoint, that means that money is flowing in towards day's end. I buy that towards the end of the day. I don't have a percentage for you, but it's probably about 80% of the time I'm making money on that trade the next day. Let me give you like one other example, maybe one that I would not buy. So BTI down 84 basis points on the day. If I punch that in at day's end, this one's actually doing a little bit better. I might actually consider that. Can you see how that is moving above the midpoint so far? So if that trend continued by day's end, that might be something that I might consider buying. So just something that's working for me, looking for stocks above the midpoint. If it's going the other direction, it makes it easy for me. I just don't even consider it. So maybe take a peek and see if that might work for you guys. And Tim, I'll go ahead and start the what's ahead for me.
Yeah.
I'm looking at a month-to-month transition. So that's coming up here tomorrow and then the early part of next week. We're above the red line right now. Just as a reminder, when you're above the red line, historically, we've averaged about 60 basis points. So the market continues to move higher in this environment, but market gains just slow down. It's not an environment where the market tends to implode. One thing to look for next week would be new month, new money. And then otherwise, it's a fairly quiet week until we get to next Friday, which would be the monthly employment update. So that's kind of what I'm watching, this monthly transition. We continue to have passive money that's supporting the market. And I think as they do, that's once again driving down intraday volatility across the market. These trends will end at some point, but for now, they remain in play. And Tim, I'll turn it over to you.
Yeah, well, I agree with that. I would say, well, what one thing would change that? And it only takes one thing, and the one thing is stocks fall, and you might laugh. It's like, well, no kidding, right? but you think about how this model that we are, the model that reflects how the market works, what it depends on. So if you're deploying money in passive models and you just relentlessly do that because people in their 401ks and so on are continuing to commit resources to target date funds. You've got that. You've got the explosion of covered call strategies where principally the aim is to generate a yield from options. And, nothing really threatens that model unless stocks decline. Right? If a stock declines it doesn't take very much to the degree it offsets the yield that you're generating, well, then that model stops working. If the model stops working, then it can affect people's willingness to continue to commit money to those longer term models. And if you think about, well, who's got the most? Well, it's difficult to say. The largest group, millennials, there are 74 million millennials. So what is the earnings power of the millennials and how much are they putting into those plans? Well, clearly quite a bit, I would say, because of the durability of the market. But I think about these things. You all know, you who are here all the time know, I'm always thinking about, well, what if? Right? What is the thing that you look for? And I still could say NVIDIA. It only takes one thing to cause the entire model, because it's so dependent on a small number of stocks, to reverse course. I mean, we're certainly overdue for a spike in volatility, but what's overdue? Who defines what the due date is? Well, no one. So, I don't know when those things are going to happen. That's the problem. I do know the one thing that will cause it. There's no question that a sudden faltering in equities would cause it, and it could be, very meaningful. The signals we often look for are low volatility, because we're thinking about that all the time. You look at the demand supply equation, and I'll finish with this. It's really interesting how it's the same. I've got the whole year here, but if you just back up and look at 3 months, and you just look at the most current point, these and these are basically the same. You can see that there's a slight bias to the demand side. Yet if you looked at the demand curve, you would say, well, it's kind of weakening. I said this before, but you'd look at that and say, well, what would you get from that? Exactly what we're getting. Very low volatility and a market that with flows will rise a little bit. That's what you get until one thing changing. I can't tell you when that'll be. I do think it's interesting that tomorrow are index options expirations, and that is much more impactful from an NVIDIA perspective than is the equity itself, because everybody substitutes. So I think, I don't know what's going to happen. Monday is a holiday, so you've got index options expirations tomorrow, and then this long weekend. I don't know. I'm certainly. I do have a volatility play here, because I think it's so low, and it's made money because it was so low that you're like, well, the probability is that it rises. I'm not recommending that. Those are things I like to do, but I don't recommend that you do them. It's risky. So we'll see. I mean, I always look at those points in time where if something is going to happen, that might be when. 1980, not to go back to, I'm old. 1987 is when I first bought a mutual fund. I was a college sophomore. And it was after the crash, October 19, 1987. And I went and talked to the business manager at the university. He said, go do this and, look for that. And so I did. But it's interesting that back then, in that summer, there were dissenting Fed governors who led to Paul Volcker's resignation. There was concern about a trade deficit. There was concern that the interest rates were too high. It was 7.25% Fed funds rate then. And that stuff was fomenting. And we got Alan Greenspan. James Baker threatened to devalue the dollar. All of this was occurring, and we went into October expirations, and people were just starting to use automated trading and portfolio insurance with options and futures. And we had a really rough October expirations, and October 19 market dropped 22%. So, you never know what things, and the same things have happened before. The way we think, oh, it's unprecedented what's occurring. No, it's not. It's happened before. Most stuff has happened before. So at some point, one thing will happen. I wish I knew what it was. I don't. So we'll just keep watching the data.